Open your banking app right now. How's that looking? Yeah, same as last month. Maybe worse. Gas is up again. Your rent just increased times again. And you're quietly doing the math in your head on whether a vacation is even realistic this year. Now open any stock market app. Green. Green. All-time high. New record. Green. The S&P 500 just hit its highest point in history right now. In 2026, while American consumer confidence just posted its lowest reading in 75 years. Not 10 years, not 20, 75. So either Wall Street knows something you don't, or Wall Street simply doesn't care about you at all. Here's the uncomfortable truth. It's the second one. And the way it actually works is more messed up than most finance channels will ever tell you. Every time the market hits a record, some politician jumps on TV and says, "The economy has never been stronger." And technically, they're not lying. They're just using a scoreboard that doesn't measure your life. Here's what the S&P 500 actually is. 500 of America's biggest public companies. But it's not even spread evenly. A tiny handful of mega-cap tech companies make up a massive times chunk of the whole index. So when you hear markets hit an all-time high, that might literally just mean NVIDIA had a great quarter. That's the entire story. Meanwhile, Americans are collectively sitting on $1.3 trillion in credit card debt, an all-time record of its own, just a slightly less photogenic one. The market going up and your life getting better? Two different events. They just times sometimes. Times happen at the same time. This year is not one of those times. So what's actually driving this rally? One word: AI. Every major bank, BlackRock, JP Morgan, Fidelity, is pointing at artificial intelligence as the engine behind this bull market. And the numbers back it up. NVIDIA, the company making the chips that power AI, made more profit last quarter than the entire U.S. airline industry made in a full year. Let that sink in. Analysts are now projecting 22% earnings growth for S&P 500 companies in 2026. That kind of number usually only shows up when an economy is times crawling out of a crash. We're in year 7 of an expansion. It's almost unheard of. But here's the catch nobody mentions. Most of those gains are concentrated inside maybe 7 companies. The other 493 stocks in the index need to roughly double times their earnings growth rate, just to keep pace. One bad AI earnings report. One sign that productivity gains aren't materializing fast enough. And that green app turns a very different color very quickly. Now, here's the concept that genuinely changed how I look at markets, and I wish someone had explained it to me earlier. Markets don't just go up when things are times good. They go up when things are times less bad than expected. 6 weeks ago, Wall Street was pricing in a 37% chance of a U.S. recession in 2026. Oil prices were spiking because of the U.S.-Iran conflict threatening the Strait of Hormuz, a single waterway that carries roughly 20% of the world's oil supply. Investors were genuinely scared. Then came early signals of peace negotiations. Oil fears cooled times slightly. And within 1 month, those recession odds dropped from 37% to 17%. Markets exploded upward. Not because your groceries got cheaper, not because your rent came down, not because anything in your actual life improved, because investors breathed a tiny sigh of relief, and the wealthiest people in the world got richer overnight. Think about that the next time you see a green day on the news. Here's the part most finance channels skip, because it's genuinely uncomfortable. Every time there's a crisis, 2008, COVID, now governments spend trillions to stop the economy from collapsing. Some of that money reaches regular people. They spend it immediately on rent, food, and bills. It's gone within weeks. But when that money reaches wealthy individuals and large institutions, they buy times assets, stocks, real estate, private companies. More demand for assets means higher prices. Higher prices mean people who already own assets get wealthier. People who don't, they fall further behind every single cycle. And right now, this is showing up in what economists call a K-shaped economy. Picture the letter K. One arm, going up. One arm going down. Wealthy Americans are spending freely on travel, premium goods, experiences. Lower-income households are cutting back on basics, and because corporate earnings are driven almost entirely by what wealthy people spend, profits stay strong, and the market stays up. The stock market only measures the arm that's rising. It doesn't even see the one going down. Here's where it gets really interesting. Wall Street isn't even that confident this lasts. Recession odds for 2026 have cooled, but recession odds for 2027 are sitting at 41%, nearly a coin flip. Why? Because the cracks forming right now don't disappear. They just get delayed. Record consumer debt, negative real wages, meaning your paycheck is buying less times than it did last year, not more. AI valuations that require perfect execution indefinitely. And an oil situation that's one bad headline away from spiraling again. There's one more risk nobody wants to say out loud. What if AI doesn't deliver fast enough? What if the productivity gains take longer than markets expect? Suddenly, those sky-high valuations look very different. The wealthy households propping up consumer spending see their portfolios drop. They stop spending, corporate earnings follow, and the K-shape becomes a cliff. The market isn't stupid. It just has a notoriously short memory. And right now, it has chosen to party. Remember that green app from the beginning? Here's what it's actually telling you. The companies powerful enough to dominate the index are doing exceptionally well. The AI boom is real for now. And wealthy investors are pouring money into assets because there's nowhere else to put it that beats inflation. What it is, times not times, telling you that the economy is fixed, that your life is getting easier, that the gap is closing. The stock market hit an all-time high today for some people. And if you want to start becoming one of those people actually owning a piece of this market instead of just watching it from the outside, subscribe. Because next week, we're breaking down exactly how everyday Americans can get in, without needing to already be rich to start. See you there.